Welcome to Enlightened Wealth Strategies, the podcast where insight and knowledge meet opportunity. Please join us as we navigate the world of finance, discovering actionable strategies to help you achieve your personal financial goals.
With decades of combined experience, we're here to shed light on the topics that matter most to your financial well-being. Whether you're accumulating, preserving, or distributing your wealth, this is the place for you.
Now let's dive in and start your journey to financial enlightenment.
Welcome. How are you today, James?
I'm doing terrific. Thank you, Jim. How are you?
I am good, thank you.
Well, welcome to Enlightened Wealth Strategies.
Thank you. This sounds exciting.
It is.
Well, we have to deal, obviously, with topics that a lot of people just aren't sure about where to begin. So let's start off, since you're a CPA and we're coming to the end of the year, why don't we start off by talking about some year-end planning for clients?
Yeah, we could talk about year-end tax planning strategies.
I think that'll be awesome.
Yeah. Well, there is a lot to unwrap, as there is every year. So my experience has always been based on my training from many years ago. I won't tell you how many years ago, because if I say it, well, I'll date myself.
You're
like
young.
35 plus
young
years. I started when I was 12.
Yes.
But anyway, back then, we did not just tax compliance, the preparation of a tax return and the filing thereof, but we did throughout the year tax projections or estimates. So clients were not surprised. They knew what their tax liability would be come April.
As a CPA, though, a lot of CPAs don't work on tax projections, and that really falls into our category as advisors.
Correct. That is true. There are a lot of tax practitioners that don't because they're smaller, solo, and not to denigrate them in any way, and it is also, there's a tax professionals throughout, the country that may not have specific designations as a CPA. They might be EAs, enrolled agents, but they don't have the bandwidth to do that. And it costs, time. And time is, of course, there's a fee associated with that. So they may not be able to do that. But we as planners are able to provide that type of a service for clients. And we really should. If you're not, you really probably should be doing that for people. Because if you look at the planning aspect, you're creating personal financial statements, which I always tell clients, whether they're a financial planning client or a tax client or both, is that you, like any other business entity, has financial statements. You have a cash flow, which shows your revenue and expenses. You have a balance sheet or a net worth statement, which shows your assets and liabilities. I'm being very much of an accountant right now.
Right.
But that's the reality. And so it's not any different for an individual. You have those personal financial statements, whether you know it or not. You may not have them in black and white, but when you work with someone like myself or you, we're going to create that. The other statement is an income tax projection, because that's one of the client's biggest expense. It's biggest line item expense in that cash flow statement. So it is important for us to know what our liability is going to be. And unfortunately, many people don't do it because either their professional's not doing it or they're not considering it. And oftentimes you'll hear clients say, "Oh, I got a big refund." Well, we don't want to get refunds.
No, you really want to try to keep what you pay the government as minimum as possible. Better for you to invest the money and have it in your pocket as opposed to having it sit with the government, earning nothing.
Well, correct. Here's what I think resonates with a lot of clients is when I say to them, "Well, you like getting a refund? Oh yeah, then I can go spend it on maybe an appliance or vacation." Or I said, "That's really nice, but I wanted to ask you a question. So if you owe money to the federal government and you don't pay it on time, they charge you interest and penalties. But if you're going to get a refund, They don't give you interest.
Yes, they don't.
So isn't it better for us to do a tax projection? And if we can determine that you're going to get money back, that we change your withholding and or estimated tax payments to cut them back so that you have more money in your pocket on a monthly basis.
So, as a potential candidate or somebody looking for guidance, what would you recommend that they look for from an advisor or a CPA?
With regard to this
Yes, this
issue,
topic.
we got to look at their pay stub because a few years back, when they changed the tax law in the 2017 tax legislation, one of the ways that they wanted to get people to have more money was they adjusted the payroll withholding tables. So
Correct.
people became under withheld. So they had more money, but then they were wound up paying more tax come April. It's a balancing act. You really need to do a projection, not just on the salary that you're earning, but if your spouse is also working, that needs to be coordinated with it. Then you need to look at your other outside income and then the deductions as well. Now, with that tax legislation, they adjusted the standard deduction. So they raised them, they removed personal exemptions. And based on your filing status, there's different values to the standard deduction. So a lot of people were not able to utilize itemized deductions such as medical expenses, charitable contributions, mortgage interest expenses, um, and of course, state and local taxes and real estate taxes, which are now limited combined to a $10,000 limit. So a lot of people got upset about that and said, "Gee, why am I only getting 10,000 when I used to pay quite a bit in state taxes and I'm not getting that benefit?" Well, there's always a flip side to every coin, right?
Mhm.
There's heads and tails.
Yep.
So the flip side to that, particularly in the high state taxes, like where we live here in lovely New Jersey
Yes.
and New York, Connecticut, Massachusetts,
California.
California, Illinois, they have high state taxes. Particularly California, they're head and shoulders above everybody. I think upwards of 14 or 15%. But you don't get that as a benefit any longer. But again, as I said, there's a flip side to this. Typically, those people fell into the AMT, otherwise known as the alternative minimum tax, which changed everything. It basically removes certain itemized deductions, adds other deductions, and it's a parallel tax. Now you don't see very many people falling into that anymore. So when clients of mine have complained, well, I don't get the state tax. Yeah, but you're not in the AMT anymore. So we don't have to contend with this ridiculous parallel tax, which when it was instituted back in the late 60s, I think, it was really to capture these high income earners that were completely avoiding tax altogether. And it was a very, very small percentage of the population, but that tax never was indexed. So it just was static. So it started to capture more and more people.
Interesting concept here, or at least a thought that occurred to me, is we just went through an election.
Mhm.
And now we have the results of those election, and things are going to be obviously making some changes. We've been hearing through the commercials that things are going to be setting in regards to tax equations.
Yeah, so you're talking about this sunsetting of the provisions related to the Tax
You know,
Cuts
how will
Jobs Act.
that actually impact the results of what people are doing today with tax planning and projections? Anything at this point, or is it just simply for the estate planning purposes?
No, I think it's going to encompass everything. But what I think we don't know what Congress would do with that. Here's why. There's two pieces. It seems like as of today, both houses of the Congress, the Senate and the House of Representatives, have been, um, they're going to be in majority of Republicans, right?
Correct.
Slim, but still, nonetheless. Therefore, President-elect Trump, he was instrumental in passing this 2017 legislation, which is going to sunset in 2025. I don't think he's going to want to permit that to be sunset. And since looks like he's going to have Congress working with him, perhaps they're going to just change certain provisions, maybe extend other ones, eliminate other ones. Don't know. He's not really spoken to that, but I do know that a number of those particular provisions are probably going to stay in place. Whereas if this were a different result, I would have expected that would have been completely gone.
Yes. So what do you think is going to happen now with regards to taxation? I mean, Congress and the House and, well, the Senate and everybody else is tallying up some mighty expenses.
And that is a big issue because now we have a deficit that's
In the
increasing $1
trillions.
trillion every 90, 100 days.
Right.
Is that pace sustainable? Obviously, it's not. So where are we coming up with the money to stop this? Well, now already there's so many. You could see it in the last few days. You see these discussions that, Ukraine and Russia, for example, they're actually agreeing to some sort of a moratorium or discussion on ending this conflict. That would be great in a way because those dollars that we're sending abroad for this conflict
Stay here now.
would stay here. That would be number one. Number two, I think that President Trump has talked about, I was actually stunned by this in a way. He's always talked about tariffs.
Mhm.
I'm sort of in the middle about is tariffs the best thing? Because it does cause those products and goods that come from abroad, now they have a higher price tag. So people have to pay for that. However, you also announced there's also companies that have already announced that they're going to be starting to move back to the United States, as opposed to having their factories and warehouses, et cetera, abroad.
Right.
So that means more jobs. And I was just explaining to someone about this. They said, well, tariffs are bad because I'm going to wind up paying more for a product. Yes, here's the however. Those tariffs are not just going to be imposed on China only. They will be imposed across the board on various industries. And therefore, those particular industries will then be protected here. More jobs will be created. People then have a choice of either buying a product that's produced here or produced abroad. Maybe it's better, but you're going to pay more because there's a tariff attached to it. At least that's my understanding. Now, the second component of this, he was, I guess I saw excerpts. I don't think I could sit there and watch a podcast for 3 hours. Hours were not going to be that long.
Let's hope not.
But in his discussion with Joe Rogan, they brought up tariffs. And he explained that he, being President-elect Donald Trump, said tariffs in the 1880s and 1890s, now we're going back 130, 40 years ago, that was where our government received their revenues. There was not an income tax at that time,
Right.
a national income tax. That wasn't passed until 1913.
Right.
So how did the government run? Now, granted, the government's much, much bigger today, for good or for bad. And he said, so if you're going to impose tariffs, are you also going to eliminate the federal income tax? And his response was, we might look at that. I don't know that they're going to be able to do that entirely. That's going to take quite a long time to do that. But maybe adjustments could be made where taxes are not going to be as high or certain things will be removed. If you look back to the original tax law, it was a one-pager, the 1040. It was a 1040 in the early 1900s. And it was only a few line items and a few deductions.
Yep.
And that was about it. And it didn't affect a large percentage of the population. So no, not too many people complained. But then it got bigger and bigger and bigger. And here we are, 100 plus years later.
Now I got us off topic a little bit by
That's okay.
bringing this in, but let's go back to what should people be looking for now that we're coming to the year end in regards to potential planning? Because in my opinion, too often our clients, no, potential clients, as we bring them on board, don't have a lot of ideas as to what to expect from persons like ourselves. Should they be looking at estate planning? Should they be looking at um, regards to, well, we talked about the income tax, but should they be looking at charitable giving and retirement planning and all investment planning? And
All of those areas should absolutely be looked at. So let's unwrap a couple of them and see if we can address a few of them at a time. Firstly, as I mentioned before, you really want to collect data from a client, which would be their prior income tax returns,
okay,
both federal and state, to see what was filed and what occurred then, because that becomes the basis of the foundation to prepare a projection for the current year. Then their pay stubs, both husband and wife, assuming that they're both working. And now you also could look at their 1040 and you could see where other income, unearned income like interest, dividends, capital gains, if they have a rental property. Now you bring all those into play. And then their deductions. If they have itemized deductions that exceeded the standard deduction, as I mentioned before. I would still go through that exercise even if it doesn't, because there might be some state benefits depending upon what state they live in. For example, despite the fact that New Jersey is a gross income state tax, you do get a medical expense benefit above 2% of your gross income.
right.
So uh, that that's why you need to go through the exercise, despite the fact that you might not think that you're going to get a benefit. Then you want to look at within the pay stub, you're going to find out whether a person is contributing, for example, if they work for a company, if they're contributing to their 401k plan. And if they're not, and they have one, why not?
You'd be surprised how many people don't.
Don't. Right. For sure. Now, some people don't because they don't have the ability to, um, maybe because they're in a tight situation, on a month to month basis. It's the old saying, do you have money at the end of the month or you have month at the end of the money? So the
Mhm.
money's gone, but you still got 2 weeks till payday. So that happens, unfortunately, to people. So 401k plan may not be an option for them. I always say, look, let's maybe make the contribution. Maybe you don't max out, but you need to look at what the employer is giving you,
Of
because that's
course.
money you're leaving on the table. If they're going to give, it's like a bonus, which is often overlooked. Now,
Mhm.
as you well know, a lot of these plans now are automatic. They have to opt out.
Yes. The 3% mandate
Hmm.
for auto enrollment has begun for any new plan taking place.
Correct. So that is a way in which people are already in it, but some people might opt out, which doesn't make sense. The other piece that they should be looking at, well, there are actually two. Do they have a Roth component? Do they have a Roth 401k plan?
Mm.
I would automatically, any younger people in their 20s, 30s, and even 40s, they should be making a contribution to that. Maybe you think differently, but I think some portion of that contribution that they would make, they should start to get it into the Roth IRA, because it ties into what you mentioned before with regard to future planning, estate planning.
Yeah. And I do see the component being of use for some people.
Hmm. I think it's
I've
a case
always
by case
yes,
basis.
it is. I've always been a pretty big component of deferring taxes as much as possible.
Hmm.
But lately, with how people have been earning so much more money, especially in the younger people, the younger generation, that Roth, I could see being a valuable play for down the road as well.
Yes, for sure. And then the other one is the IRA deductions. A lot of people don't, they overlook that. So if they can, they could even make a contribution on a non-deductible contribution basis. So that could be beneficial because the more, as you just said, that you can defer towards retirement is smart.
Mm. What other type of planning should somebody be looking
Like
at?
you mentioned before, investment considerations.
Mm.
One thing that that should absolutely be looked at, and I don't want to use fancy terminology, but we call it harvesting tax losses, or even offsetting gains. So if you have
Mm.
gains that are substantial, are there some losses in your portfolio that maybe those particular securities, stocks, or bonds just didn't perform so well over the last year or two? Perhaps taking a loss to offset those gains to lower your overall tax liability
Okay.
is an option. Um, yeah, looking at just something as simple as dividends and qualified dividends. I mean, not much you could do there. It depends upon what company you're investing in, but they have a different tax rate if they're qualified dividends. It's a little bit lower than your ordinary income tax rate, which would be higher. So that's a consideration as well.
Okay. So there are some advantages with reviewing the investments. How about charitable giving?
Charitable giving is also another one that's often overlooked. Um, most the bigger issues there are making sure you have proper documentation, substantial documentation, as the IRS likes to call it. If you're making those regular contributions to your church or synagogue or wherever you might go, you'll have that. But if you make contributions to any other organizations, they're usually going to give you a letter letting you know that you made a contribution. You need to keep those and hold on to those. But also another area there's a couple different areas, but there's one that's often overlooked too, is what we call non-cash contributions. So when you make those contributions to the Salvation Army for furniture or clothes, you're really supposed to get a receipt that gives you some sort of value attached to those items that you made a contribution to.
Correct.
And they can add up because you do spring cleaning
Mm-hmm.
and you discover there's a whole lot of things that are not used in the house anymore. Because
Yeah.
a lot of people hold on to things. That's why storage units do so well nowadays. um, that could be substantial, and maybe that helps to get people over the standard deduction, and you're going to get a little bit more of a benefit overall off the top of your taxes. Now, keep in mind that's a deduction as opposed to a credit, which a credit applies against your tax liability. So there's a lot of different credits. I don't want to necessarily go down that path, but there's all kinds of different ones. As I said, that's an offset directly to an individual's tax liability.
Now, I know when it comes to planning, there's tax planning versus financial planning. One of the things that gets overlooked a lot of times by people, at least in my opinion, is estate planning.
Hmm.
Everyone, in my opinion, should have at least 3 basic documents, and that would be a simple will, a durable power of attorney, and a medical directive. I'd be surprised how many people don't have that. Even with advisors, I've seen advisors not have that, and yet they're telling their clients they should. If we go back to the estate planning aspect, though, there are times when people have special needs like you do,
Yes.
and that is always seems to be always overlooked.
Well, let's unwrap each of the points that you just made. So, as I learned many years ago from one of my employers that I worked with, he stated very clearly, yes, we do need to do financial planning for you, but if we don't address the estate planning and you walk outside and get hit by a bus, all the financial planning I did for you is meaningless. So
Exactly.
it is important and incumbent upon us as professionals to make sure that, yeah, we do the planning, but you really kind of have to address the estate planning simultaneously or in tandem with the planning that you're doing. Unfortunately, human nature is most people don't want to deal with it because you have to address your mortality. Who wants to do that? It's understood, but it's invaluable, and it's important for us to bring them to do that. I liken it to when I was a kid. I went to the dentist when I was a teenager. I had a bunch of cavities, and one tooth was really bad,
Mm.
and I knew it had to be taken out. My mother knew it had to be taken out, but the dentist filled all the cavities over a 3 or 4 month period, and he pulled the tooth last. Why? Because if he pulled the tooth first, I may not have come back for the cavities. But it's sort of like estate planning. People don't want to deal with it, so a lot of planners don't want to address it because if we deal with that, they might not feel comfortable, and therefore they may not fulfill what you would want them to do with the financial planning.
Mm.
So the way to kind of split the difference, I think, is to do it at the same time. You want to address it, make sure it's in place. Because of the importance of it, as I said, something, God forbid, happens, that estate plan's not in place.
By the way, why is it that you and I always use the proverbial bus?
You want to use the dump truck? It's okay by me.
I say the same thing. I just found that interesting. We always say the hit by the bus.
And a lot of people don't live in the city. They might live in the more suburban or rural areas.
Yeah.
There are no buses around.
What we should be saying is you just never know when the time is up. The time is up.
A drone might hit you in the head.
This day and age, you never know. Oh, I'm
as
sorry.
far as the special needs is concerned, that's a whole nother element. Most families that are dealing with special needs child, they're overwhelmed, and planning, they know, is important, and it's very, very difficult. And we're going to be talking about this in the future too. We're going to have some other guests as well, but
It's definitely overlooked.
yeah, it's overlooked, and it's very difficult for a lot of families to address it because, as I said, they're overwhelmed. They have a lot that they're dealing with. They know the importance of doing it, but again, it's also dealing with an issue that is not easily solvable. So the typical family, traditional family, uh, it's, I think, a little bit easier, but with the special needs family, it's much more challenging.
So we've actually covered a pretty broad categories of planning. Do you feel there's anything else that we're missing?
There is one when we prepare a tax projection, it's important now to realize what we've done as far as what the tax liability we're estimating or projecting it to be.
Okay.
Now we have to make sure that we have enough withholding and or estimated tax payments paid in, because you want to avoid underpayment penalties. So you need to look at what the current year's tax liability is being projected and what the prior year tax liability was. So you need to have in, for federal purposes, either 110% of the prior year's tax liability or 90% of the current year's tax liability paid in, the lesser of. So if somebody has, I'm just making up a number, 110% of 100,000, so 110,000, that's their tax liability. If they have withholding that exceeds that, great. They're fine. They're not going to have an underpayment penalty. And somewhat the same for states. States might be 90% and 110%, or some might be 100%. Jersey's 80% of the current years and 100% of the prior years. New York is the same as the federal, I believe. But each state is a little bit different. But that's important to know.
Especially if you don't want to pay a penalty.
Especially you don't want to pay a penalty, but also, as I pointed out earlier, we don't want you don't want to have any surprises come April.
No. I know I pay estimated taxes, and I know you pay estimated
Mhm.
taxes, but that's because of the fact that we really don't collect a paycheck. We're 1099 employees
Correct.
for the most part from the different vendors that we utilize. Those that get a W-2, though, how do they, because they may have other investments.
Correct.
How do you
It's a great
address that with them to make sure that they make estimated
This is
payments?
a great question. Excellent question. I apologize that I didn't think of this, but if you have sufficient withholding throughout the year, see, here's one thing that we need to distinguish. Estimated tax payments, it depends upon when they're made. So there's 4 quarters.
Mhm.
So if you pay them at certain points in time, they're gonna apply to that quarter.
Right.
So that's how the IRS is gonna calculate it and to determine whether or not you're gonna have a penalty, interest, or both. When you make withholding, your employer is making that payment for you each payroll.
Mhm.
If you didn't make any of them throughout the entire year, and December 31st, your employer withholds, again, making up a number, $100,000. Doesn't matter. It's as if you paid it ratably throughout the year. So it doesn't get applied as an estimated tax payment. So to answer your question, if a person has withholding on their salary and or bonus or any other payments from their employer, it might be enough and it may not be enough. It depends upon what withholding exemptions they have. But let's just assume they do. They have sufficient withholding for that, but not enough for the other income. So what do? They could do one of two things. They can make an estimated tax payment or multiple estimated tax payments. But if I try to avoid that, if a person is an employee, a W-2 employee, I prefer that they pay everything through their withholding. So I'll adjust their withholding to account for that income rather than them also making estimated tax payments. But if somebody like you and I, who are, more or less self-employed, or someone who's retired, I'm going to want them on estimated tax payments. We have to really because
Yes.
there's no other way.
Correct.
And so that's where the projection comes into play too, because we want to make sure on a quarterly basis that we have paid in sufficient tax throughout the year.
Understood, and that all makes sense. I hope our listeners can appreciate that. Is there anything else that we need to cover at this point in time within the
Um,
tax planning? I mean, we obviously are going to have more segments down the road that we can get
yeah.
into the individual stuff, like about um, special needs planning, and probably dig in a little deeper on the estate planning aspects with having some guest speakers down the road.
Yeah, and also the retirement plan as well,
Retirement.
because we're
Yeah.
gonna touch on a lot of that.
Yeah.
So that could be a good segue for us to, maybe those other topics, the retirement planning, the estate planning, the investment considerations. We're gonna have multiple topics to talk about that. So talking about year-end tax planning is important because we are already in November. People, if they haven't begun to do it, they certainly should before the end of the year. As I said, don't want to be surprised. But for future topics, absolutely. The estate planning, special needs planning, the investments, and a multitude of other things. So maybe we end at that with the thought of looking at retirement plans, IRAs, Roth conversions, and planning and strategies surrounding that to enlighten more people.
I like the idea. I think a lot of times business owners, as I deal with a lot of business owners, and I find that a lot of times they're good at running their businesses, but they sometimes fall short on understanding the retirement plans and how they actually work. And all the rule changes. We had the Secure Act 2.0 that you and I had to deal with when it comes to R&D distributions, mandates of new uh, rules with regards to the 401k, like that 3% auto enrollment. A lot of people don't know it, but that's a rule, and it has to be any new plan that comes into play has to have 3% auto enrollment for their employees. But a lot of that is overlooked, I think, sometimes. So I'd like to also dig in a couple, at least one or two more of these podcasts where we can get into working with the owners, the business owners, and helping them maximize things as well.
Okay, that would be great discussions for the future. Absolutely.
And I think that should be it for today.
Okay.
Unless there's something else you want to cover.
No, I think we covered quite a bit.
I hope our listeners have enjoyed this. Thank you for joining us on this episode of Enlightened Wealth Strategies. We hope you found today's discussion insightful and inspiring.
If you enjoyed this episode, don't forget to follow and subscribe to our podcast. You can find us on YouTube, Apple Podcast, Spotify, or your favorite podcast platform to stay updated on new episodes.
Your financial journey doesn't end here. Connect with us online for even more resources and exclusive content.
Until next time, remember, financial enlightenment is just an enlightened wealth strategy away. Investment advice is offered through Bell Point Asset Management, LLC, 500 Demont Ranch, Parkway Building 700, Unit 700, Reno, Nevada, 89521. Additional information about Bell Point Asset Management is available on the SEC's website at www.advisorinfo.sec.gov. It is important to read our disclosures available at this link, www.bellpointasset.com, disclosures. The information provided in this presentation is educational and limited to the dissemination of general information. This material is not intended to be a recommendation of any kind, investment, tax, or accounting advice. It does not constitute a solicitation to buy, sell, or hold a security or an investment strategy, engage in any financial transaction, and is not provided in a fiduciary capacity. The information provided does not take into account the specific objectives or circumstances of any particular investor or suggest any specific course of action. Investment decisions should be made based on an investor's objectives and circumstances and in consultation with his or her financial professionals. While the advisor uses reasonable efforts to obtain information from sources believed to be reliable, the advisor makes no representation that the information or opinions contained in this material are accurate, reliable, or complete. All information and opinions contained in this material are subject to change without notice. The views and opinions expressed are for informational and educational purposes only, as of the date of the production or writing, and may change without notice at any time, based on numerous factors, such as market or other conditions, legal and regulatory developments, additional risks and uncertainties, and may not come to pass. This material may contain forward-looking information that is not purely historical in nature. Securities offered through Fortune Financial Services, Inc., member FINRA and SIPC, Bell Point Asset Management, LLC, and Fortune Financial Services, Inc. are not affiliated. Past performance is no guarantee of future results. Investing involves risks. Principal losses possible.